if we look at the fund flows data, it sure as heck appears as though there continues to be fuel for a rally almost across the board. What are you seeing right now?
Yeah, I mean, absolutely, that's the case. When we take a look at the sentiment around equities, and of course, when we're thinking about equities, it's hard not to look at the epicenter there with technology and AI. There still is a very strong bid there. I think there's a lot of positive sentiment, and of course, the fundamentals support it, especially when we're taking a look at earnings and the way that they've surprised to the upside for Q2 earnings and expectations for more of the same as we head into Q3 earnings season. So I think there's a good fundamental case for the enthusiasm for equities. The question is, where are valuations and how much of that good news is priced in? And at least as we take a look at valuations, those seem pretty stretched.
So if they do seem pretty stretched, why is it that people still remain so bullish about it? Is it just because the paradigm for valuations has changed? And if it is a paradigm shift for valuations, do you need lower interest rates to keep those price to earnings multiples expanding?
Well, I think certainly the market wants to see those rates come down. If we're taking a look at expectations, if we roll forward a year, the market is anticipating the Fed funds rate somewhere around 3%, which would bring it in line with the Federal Reserve's own average estimate for the long-term expectation for Fed funds. So it's kind of like a neutral rate on that perspective. But I think when we're taking a look at valuations, what a lot of folks are pointing to is that valuations themselves are not timing indicators. They don't tell you buy or sell based on where they stand relative to average. But what I would say is when we look at the historical data, what we find is as you get to more extreme valuations, they do become a bit more predictive. And we're at those extreme valuations today, which would suggest, at least historically, that we're looking at weaker 3-year prospective returns.
If that's the case, from a strategist standpoint, what exactly then do you advise clients to do? Should I be altering the allocations in my 401k because of those moves and valuations you're talking about, or perhaps the forward returns I might expect historically speaking?
Right. So I think job number one is really an expectations game. It's to make sure that whatever expectations we have going forward incorporate the idea that we might not see the same type of strength that we saw in 23 and 24, and then certainly in the rally post April 8th. I think the other consideration is really a rebalancing or a risk management consideration, looking at those areas that have really run and pulling those back and maybe allocating a bit to the areas that have been left behind. So tech, AI, that's a great example of a place that has just, been hard to keep up with, while other areas, healthcare in particular, has been something that's been left behind. So a little bit of tweaking, adjusting, rebalancing, taking advantage of the strength, moving into weakness. I think that's a prudent step at a moment like this one.
And Marta, before we let you go, that's the equity side of things. Within the fixed income market, within corporate credit or on rates or anything else, do you feel as though there's any kind of fine tuning that needs to happen there as well?
Well, there's the same echo of high valuations in the corporate bond space. When we're looking at spreads there, they are very tight. And of course, the fundamentals are very strong. So in some ways, they justify it, just like on the equity side. But I think here, it's that same idea of taking some of that speculative risk maybe off the table and making sure that portfolios are pretty balanced across the board.